Hi, welcome to 3 Minutes or thereabouts. I'm your host, Lance Roberts, today talking a little bit about everybody is back in the pool. You know, it's interesting here. Markets are at all-time highs, and of course, the what's there not to love? I mean, the Fed has cut rates 3 times this year. They're back to doing QE. We've got a trade deal with China. Basically, no matter where you look and what you look at, there's good bullish news. Earnings are doing okay. Corporate profits are well. Economic data is hanging in there. Again, everything good for the bulls, and of course, this supports the idea of basically pushing the markets to record highs. And again, we laid this out about a month and a half ago, talking about how a conclusion of the trade deal, that Trump wants a trade deal done, and that would certainly boost markets back towards 3,300, which has been our target for the last couple of years for the conclusion of this bull market rally. It's very interesting. Our friends over at Sentiment Trader also came out with a series of great charts today, really kind of talking about how investors are now all back in the pool. And if you take a look at the amount of money, this is equity compared to money market ratios. Investors are pretty much as much allocated to equities as they can get. And again, this kind of belays the idea that there's this cash on the sidelines. Investors currently have some of the lowest cash levels since 1997. Same thing for mutual fund managers. Mutual fund managers are now at historically low levels of cash. So this whole myth of cash on the sidelines and that cash is going to basically be providing support for continued bull market certainly brings up some questions. But if we take a look at risk appetite as well. Investors are pretty much as bullish on the market as they can get. They're taking on as much risk as they can get. And this is not surprising. With markets hitting all-time highs, one of the longest bull markets ever in history, it's not surprising that investors have simply just thrown in the towel to basically chase asset prices higher. Taking a look at the VIX term structure, which is the volatility index, the measure of how people perceive risk in the markets. That's also at levels that have typically denoted market peaks in the markets rather than the beginning of a new bull market. And again, with more investors short the VIX right now, we are at record low, or record high, I should say. We're at record high levels of shorts on the VIX. It suggests that this market is just about as bullish as it can get. And one thing you have to ask yourself as an investor ultimately is that we've had a market that's now up 113% from the 2007 highs, right? So we are up more than 100% from the 2007 peak. But in that time frame, the S&P revenue has only grown by 45% and GDP growth has only grown by 23%. So as far as the markets pulling forward expectations out of the markets and basically extrapolating as much value as you can, you have to suggest that we are actually already there. And ultimately at someday, as our friends over at Crescat Capital has put out, is that valuations will ultimately matter. As Warren Buffett once said, price is what you pay, value is what you get. And with virtually every measure of value at historically high levels, this suggests that the markets may be closer to the end of the cycle than the beginning. And again, not surprising when you see investors all in the markets. That's typically what happens at the peak of markets, not the beginning of a new bull market cycle. I'm your host today, Lance Roberts, for 3 Minutes on Markets and Money. Be sure to go by our website, get our latest podcast, blog posts, newsletters, and more, all at the website, realinvestmentadvice.com. We'll see you next time on the next edition of 3 Minutes on Markets and Money, or somewhere thereabouts there.